of us is unique, so just recognize it and live your dream. We all look alike, but we're different breeds. See, authenticity is the key to peace and a happy life, and many more things. Yeah, that is right. I would never tell you a bad advice. Wrote this cause it's what I had to write. Cause everything happens for a reason. The rain, the wind, and the four seasons. And once I noticed this fact, everything made sense and life became more decent.
Welcome to the Dealmaker Zone. My name's Steve Stone and I'm your host. Our guest tonight is Christina Bechhold. She is an angel investor, the founder of Empire Angels and a managing director, which is an angel investment group for young professionals in New York. She's also a VC at Samsung. She's a columnist with the Wall Street Journal and Inc., and she's also the chairperson of Hopes on a String, which is a nonprofit that's working towards making a difference in Haiti. Welcome to the Dealmaker Zone, Christina.
Thanks so much for having me.
So tell us a little bit about your background and what led you to start Empire Angels.
Sure. At the time that I thought about getting into angel investing, I was working at a large bank on Wall Street and had a lot of friends who were quitting their jobs to join startups or start their own companies. And I sort of saw this growing ecosystem in New York City. And I wanted to get involved in it, but I didn't want to just invest in my friends because I like them and hope that they do well. It seemed like a very bad way to go about investing your money. And so with a friend of mine from college, we started this group. And it initially was a group of friends getting together once a month to look at some okay companies that we happen to have access to. And over time, we've grown that into a group of 65 young professionals in their late 20s, early 30s, investing in early stage technology companies. So we've invested in about 15 companies and had 2 exits in the roughly 3.5 years that we've been around. And that was really my sort of entree into this early stage space. I'd always been really interested in technology. I taught myself to write HTML in middle school so that I could,
that's cool.
I could build a Buffy the Vampire Slayer fan site for those who actually remember that television show. I was a huge fan. And I think the happiest day of my life was when the official Buffy the Vampire Slayer show website linked to my site.
Oh, wow.
That was the highlight of middle school. And so I've just always been really interested in technology and the way that you can utilize it to create things. And so Empire was a really great way to get some exposure to the exciting things that people were doing in New York and try to find ways to support them. And then from there, I spent some time consulting for a startup here in New York called Ringly, which was building smart jewelry and in the sort of consumer IoT space. And then in January of 2015, I joined Samsung's Global Innovation Center as a venture capitalist investor focused on early stage software and services. So looking at more sort of high-tech opportunities where Samsung can add value through collaboration opportunities.
Got it. So talk to our audience about the difference between being an angel investor and being a VC with Samsung.
Sure. So angel investors are investing their own money directly into companies. So these are high net worth individuals or successful individuals who have some disposable capital to be able to put into very, very risky ventures where 9 times out of 10 they'll lose everything. Okay. And so you're investing your own money directly into companies. Venture capitalists are taking money from other people. Oftentimes in a traditional firm, those are family offices or insurance companies or pension funds, large pools of capital that they put into a fund, and then they have managers who make decisions about where those dollars are invested. And so at Samsung, we are investing money from Samsung Electronics into early stage companies where Samsung has some sort of strategic interest in being helpful to them.
Got it. So if you're a young professional watching the show and you have access to some capital, you want to become an angel investor, what sort of advice would you give them?
I think the best thing that you can do is try to find some other people, your friends, your colleagues, other people you know who are interested in maybe getting into angel investing and working with them in a collaborative way to source opportunities and do due diligence. I think it's very challenging and it can be very isolating to try to look at a company all by yourself in a bubble. And the best thing that I ever did was to start talking about the companies that I was seeing with my friends and people that I knew and whose opinions I respected, because they're the ones who can poke holes in your logic and tell you that amazing idea that you just saw actually has a whole bunch of things wrong with it that you would just never have thought of because your mind just hadn't caught those weaknesses.
It does make a lot of sense. I always had the question about fear of missing out, which is something that's very common. So technically, if an investment idea is good on its own, right, why do you need another investor to validate the idea before you invest in it?
Well, I think if if people were great stock pickers, they should go into the public markets and go find the next Facebook there. But generally speaking, individuals are not great at picking winners, and so being able to get as much information as you can from different perspectives who may have more information about an opportunity than you do. For example, I may not know very much about SaaS opportunities, but if I can get some expert opinions from some other people who have looked at companies like that before, maybe work in that industry, that helps me to make a more informed decision. And most angel investors, many of them try to have a diversity of different things in their portfolio. So maybe not investing in just security companies or just XYZ type of vertical.
So then it does make sense to have another investor who's potentially more knowledgeable in that specific space.
Absolutely.
To help you. So what skill set should a good investor have? So should you be good at reading financial statements, business plans? Should you be good at assessing people? What sort of skills do you think a good investor should have?
I think for early stage where I focused, that I think the number one skill is being able to read people.
Okay.
It sounds maybe cliche, but ultimately at the very early stages, ideas are everywhere. You can walk down the street and everyone has a startup idea these days.
Yes, indeed.
Ultimately, I'm investing in people, and I'm determining whether or not those people are the ones who, regardless of where their business goes, and that business is probably going to go on a very different trajectory than we anticipate at the time that maybe I'm looking at it. That those are the people who can surmount those challenges and figure out a way to get to their goal. And that just comes from meeting with lots of different people and from lots of different backgrounds with lots of different kinds of goals and trying to assess who are the ones who can get there.
But it's got to be a hard thing to do, though, right?
It is. It's incredibly hard. Yeah.
When they're pitching you, they're all excited. It's their dream. It's their idea. I'm going to make it happen. So it's got to be. So do you invest after meeting with the founder the first time, second time? You need to know the founder for 3 months, 6 months. What's your process?
Sure. I am not someone who writes a check after a first meeting. That's just not my personality. I tend to be the more risk averse kind of person and investor. So generally speaking, I like to form relationships with people over time. I don't think that any investor wants to just be thought of as a piggy bank. So
that's enough.
No, not at all. I like to think I'm more valuable than the capital I have access to. But I think that the earlier that you can have conversations with investors, not necessarily asking them for money, but getting their opinions on what you're doing and asking them for advice. This is.
So if you want money, ask for advice. If you want advice, ask for money.
I say never ask for money. Don't ask for money until the last
So
step.
just talk to the investor.
Build relationships over time, and your network is the thing that's going to be most valuable for you when you're fundraising, when you're hiring, when you're trying to get partnerships and sell your product. So building that network as best you can, I think, is should be the number one priority
for investor and for founders.
For both, yeah, absolutely. And so I much prefer to meet with someone early, talk to them about their idea, stay updated on it, and get regular updates from them, and then over time build a relationship where I have the time to tease out what kind of person they are, how are they trustworthy and forthright, are they energetic, do setbacks really get them down, or do they feel like those are great challenges? And you're able to determine that over a slightly longer period of time than just a couple of coffee meetings.
That does make a lot of sense. When you're looking at the ecosystem right now, there's some sense that there might be a slowdown in investing. What's your take on the market?
I think there's still plenty of capital available. Just seeing the number of I think it's the largest amount of venture capital new commitments were made in 2015. So there's lots of money to be put to work. I think that now the board conversations that I am hearing are less about growth and just getting out there, and the questions are now around how are you going to make money.
So you're more focused on companies that can actually.
Yeah, I think across the board, investors are frankly going back to sort of fundamentals of business and investing, which is businesses are there. They should make money, and they need to figure out some way to be self-sustaining and not just continue to raise capital and spend it. That ultimately isn't gonna work.
I have a question though. It seems like on the West Coast they have a slightly different mentality than on the East Coast when it comes to how they fund companies. Because a lot of West Coast companies, and they've had the biggest exits, companies that don't make any money. They lose a lot. Some lose a lot of money for like the first 5 or 6 years, and they keep raising more capital. Because on the East Coast, we're more focused on you being profitable, right? So some people feel like that kind of affects how big our companies can be. What's your thought?
That's certainly possible. You know, I think. You know, most of what people hear about in sort of the particularly the tech startup space is consumer companies. So, you know, yes, many of them get started out in California. That's where there's a lot of venture capital dollars available, and that's, you know, Silicon Valley has, I think, been the traditional hub for that. I definitely agree with you that there is definitely a mentality shift between the two coasts. In New York, I think we're a little more business-minded and a little more, you know, realistic, and, you know, sort of stick to your knitting. And West Coast tends to be a little more shoot for the stars, and, you know, let's hope that everybody gets there. Yeah, a lot more moonshots. We don't have as many of those in New York. And I think, you know, I think ultimately that's fine. I also, you know, not every company needs or should be really a billion-dollar company.
That's very interesting, because most people tell you that if you raise venture capital, your goal should be to build $1 billion company. So,
I mean, there's different kinds of capital you can raise, and I think that venture capital gets all of the attention, but that is not necessarily the best trajectory for every company. You know, a lot of companies that I see are not meant for venture capital. If you are going to go take venture capital dollars, you absolutely have an obligation to build as big of a company as you possibly can. That is the commitment that you're making to those investors.
But is that even healthy? Does every single founder have that big of a dream that they want to build this giant company?
I'm sure the founder I can't imagine a founder that doesn't want to build a giant company, but I think that I think it's important to understand how big can your product, your idea, your company really get. If you're in a market that is you know, a vertical that is smaller, and you're building a product that is going after a niche sliver of something, there's nothing wrong with building a profitable company that's worth, you know, tens of millions of dollars and owning all of that.
That's very true.
People forget that, you know, you going out and raising money, you are giving away the most valuable thing that you're building, which is the equity in your company, and that is something that you should hang on to as tight as possible. And I am so impressed when I meet with founders who just socially who tell me that, you know, they have not raised a single dollar of outside funding. 2 here in New York that have done really well. One is called Home Polish. They offer interior design services sort of remotely. And Uprise Art, which is focused on getting younger consumers interested in and supporting young artists through buying. 2 companies that have managed to bootstrap their way through all of their growth. You know, people, you can take out loans. There's grant money. There's so much grant money that people don't even, you know, think to go look for.
But this is your business is funding companies.
Right.
So but you're recommending to founders that maybe.
I mean, you have to do what's best for your company. I think what's unfortunate is that there's not enough honest discussion with founders about what's best for their company and what they want to accomplish, and what's the most likely outcome for them. You know, the likelier outcomes are that you can build a company, build a company to profitability and make money for yourself, and own that company as much as you possibly can. Or you build a company and it's acquired. What is very unlikely is that you build a giant company that ends up IPOing and you make the next Facebook. And so I think there should be more discussions about ways to build great, solid companies with fantastic products and customer bases that get founders where they want to go, and being realistic about what can be accomplished. I think those are equally valid paths to pursue.
And I totally agree with you. So talk to me about some of your investments. What's like one of your most current investments that you're super excited about?
Sure. So one company that Empire Angels invested in several years ago, we led a seed round for a company in India, actually, called Zoomcar. Okay. And it was 2 young guys who wanted to take the Zipcar model to an emerging market, and they chose India. Okay. After some research. It seemed like a crazy idea at the time, but that company managed to go into Bangalore and has built itself into an incredibly successful business. Sequoia Capital led their Series A round, and then they're in the midst of another fundraise. That company has been fascinating to watch in a very different market from the United States that is growing very quickly, and they have managed to make a very capital-intensive business work very well for them. So I think within the the Empire Angels portfolio, that's one of our most successful companies. And at Samsung, a company I'm really excited about is called Vinly. It's based out of Dallas, Texas. It is a connected car platform. And so they have built proprietary hardware that you plug into your car. It turns your car into LTE Wi-Fi hotspot. Okay. And then you're able to customize your in-car experience with different apps and services that are best fit for you. And those apps and services are built by developers on an open platform who get access to all the data from all the cars that Vinly is available in, and they can build apps across different platforms and services. And so we're really excited. I'm really excited about where the mobility space is headed in the U.S. and globally, and the opportunities for automotive there.
That's pretty cool. You mentioned earlier that you also invested in Juno, right? Can you talk to us about that investment? Because this is a company that's going after Uber's market.
Sure,
right?
yeah, Juno. So Juno is a new company that's launching.
And they're at TechCrunch this week.
It's launching here in New York very shortly. I'm very excited about. So Juno is looking to go into the rideshare market in which Uber is the largest competitor. What makes Juno really special is their focus on the drivers, and the mission is really that driver happiness and satisfaction in their job will lead to a better rider-passenger experience. And so Juno was established with half of the shares reserved for drivers, so the drivers actually earn equity every mile that they drive for Juno.
That sounds pretty cool.
It's amazing. It's amazing. It's fantastic. It's a fantastic service. I've been very fortunate to be an early beta tester, and I'm really excited for more people to be able to experience Juno and support this company's mission.
So I have a question, though, from a competitive standpoint. Are you a bit concerned about the fact that Lyft has raised hundreds of millions of dollars, Uber has raised billions of dollars, literally? So you did mention some key things that make Juno unique, but from an investment standpoint, isn't it high risk to enter that space?
Oh, absolutely, absolutely. I mean, every investment that I make is high risk. It's all about boxing in the risk and getting comfortable with it and recognizing it up front. That's something I learned very early in my career in finance. I think what's the opportunity with Juno, I think it'll probably be very, very binary. This is a company that has the potential to be an incredibly successful company, and that's the 50% that I'm betting on.
Okay.
So we'll see where it goes, but I think the mobility space is massive. Transportation mobility is a $2 trillion business globally, and ride sharing is an increasingly large portion of that for all of us who have to get from point A to point B every day. So I think that it's a large growing market segment that there can be multiple winners in. And I also think that I think that the value proposition for Juno will connect with passengers, and it's certainly connecting with drivers. And if the company is able to get lots of drivers on the platform and satisfied and happy, I think passengers will do the same, and they'll be able to create a strong marketplace. So,
do you think if another competitor decides to mimic that same model, of let's say suddenly Uber decides, you know what, let's offer some equity, do you think that automatically takes away their advantage? Or do you think there's more to it?
I think there's more to it. There's also some technical aspects to it that they're doing quite differently that I think will improve the experience on sort of both sides of the market. But I also think that it's difficult when you're a very, very large incumbent that already has a very complicated infrastructure and business model. It would be very difficult to pivot away from that in a really material way. So we'll see. I would be very happy to see everyone offering their drivers equity. I think that that's important to be able to reward the people who are helping to build your company.
That's very true. So talk to me about failure as an investor. So you make an investment. At what point do you realize this was a bad investment and I should write this off?
It takes a little while. I think the more time,
hope, you still
I think generally as an investor, like no one wants to kill their baby. You're going to continue to put time in it. I think I've found that the more time I have to put into an investment, the worse it's probably doing. And so I should probably.
Do the founders call you all the time?
It depends. Sometimes it's proactive, just sort of seeing, through the communication with the company that things aren't going well and trying to be helpful. And sometimes that's just a course correction, and there's lots of ups and downs in every investment. But I think at some, the part of the challenge of being an investor is figuring out when is that point when you need to just sort of step back and say this isn't working and it's time to move on. I've been fortunate to only have a few of those situations so far, but I've certainly sunk a lot of time and additional effort into trying to prop some of them up before they ultimately went under.
So how does it work with the founders? So the companies where you lost your investment, like, have you reinvested with those founders and other startups? Have you? What's the process? Does it just depend on the founders, or if the failure was because it was just a bad market, poorly executed plan, or was the failure like mismanagement or co-founder issues?
In the companies that I've seen fail completely, often it's co-founder issues. I think I read somewhere that over 60% of failed startups fail because of founder issues.
And you know that's why I'm a solo founder. That's another and I know you should have co-founders, but it's just unless you find the right one, it's just.
It's challenging, yeah. I mean, that's another marriage that you're entering into.
You
really have to find the right people, and it's a challenge. And sometimes you get down the road a bit and realize that this isn't working. And so that's often the reason why companies go under, is that the founders just can't come to an agreement on what to do, and so they have to dissolve it.
So you as the investor, if you have these two founders that are at it, what's your approach? Do you say, okay, this founder is more valuable to me than the other founder? So
it depends. I mean, it depends on sort of where the company is. I mean, that's something that the founders and their board need to figure out. And we don't often take board seats, but. I try to be as helpful as I can to founders who are struggling with those issues. Sometimes it's just different work styles. Sometimes it's ultimately different goals and for what they want for themselves and for the business. And I think the most important thing is for founders to communicate with one another and be really honest and upfront. There's this concept that's been floating around for a while that's very popular now called radical candor, which is the idea radical candor, which is the idea that you should be forthright and direct with people about feedback and give it in real time, and not in a nitpicky or difficult way, but just in an honest way, so that issues don't fester over time and then ultimately lead to bad outcomes. And I think that's really important for founders. Like you can't let the little things that you do to each other upset over time. It does, and then eventually it implodes. Yeah.
Got it. We're almost out of time. I have a few more questions. So do you prefer being an angel or a VC, or at some point do you just want to be a VC?
I like both. I think angel investing is where I got my start, and I put my own capital at risk to learn this business, and that's been fantastic. And being a VC, particularly a corporate VC, where I get to leverage the resources of this amazing organization to be able to help founders, is a really special opportunity. So I really love doing both. More than anything, I really think I have one of the best jobs in the world, because people come to my office every day, and I spend my time meeting with them, talking about these amazing things that they're trying to do, and figuring out if through this network and these resources I have, if I can be helpful. So I will continue to look for opportunities to do that in whatever way I can.
Awesome. One more question. Talk to me about your nonprofit.
Sure. So Hope on a String is a 501c3 nonprofit that we started about 6 years ago. It was started by a friend of mine from high school, Bennett Rathbun, who remains as the executive director. The organization was founded after the earthquake in Haiti, and the concept of it that really drew me in was the idea that it was a brand new developmental model for the country. Haiti is a place that a lot of charity dollars have gone to and a lot of work has been put into, but it continues to suffer from a lot of systemic challenges. And so the idea that we had to test was going outside of Port-au-Prince, where a lot of the activity is focused, into a region, Arcaye, setting up a community center in a former brothel, actually transforming that into a community center, and using music and performing arts, which are pillars of Haitian culture, to bring people together. And so students can come in, they learn basic musical theory, they can learn an instrument, dance, performing arts. We have a variety of different tracks for people, and they build up confidence and a skill set over time. And what we're seeing now is that the students that have gone through our programming, we offer about 90 hours a week, are now looking for opportunities to be able to go and utilize those skills in different ways. So some who went through the program just wanted to find ways to be more helpful to their community. We've seen these fantastic local groups pop up that really want to take responsibility for improving their own community, which is amazing. We also have performance groups that are now starting to perform, paid gigs at local places. So it's been really fascinating to be a part of, and we've now started expanding our programming into local schools regionally, and we're hoping to spread that throughout the country in the coming years.
So if somebody wants to get involved and help with the nonprofit, what should they do?
They can go to hopeonastring.org, our website, and get some more information. And there's a place there to be able to reach out to us. We're always happy to take on volunteers. There's certainly plenty of work to do. And if anyone wants to travel down, we're always happy to take volunteers down to see the work on the ground.
Awesome. Thank you so much, Christina.
Absolutely. Thank you so much for having me.
Absolutely. And this is our show. If you want to learn more about the Dealmaker Zone or be on our show, send us some feedback. Please shoot us an email at show@AnySizeDeals.com, and that's the last word.
No matter how you choose to live, be yourself. Cause your authenticity is a gift, so be appreciated.
Gotta be yourself, be authentic, and you see that you be free as well. Gotta be yourself, gotta be yourself, be authentic, and you see that you be free as well.
Who are you really? Go find it out. Your heart will tell you what life's about. Don't believe what your mind will shout. I'm optimistic, no time for doubt. I focus on the good things in life, so I'm attracting the things I like. You can learn from everything I write, but do whatever you think is right. You will be